What if I told you that some of the largest pools of capital in the world are quietly, almost invisibly moving money out of artificial intelligence and into oil, into energy, into the sector that most investors have spent years ignoring, underweighting, and writing off as yesterday's economy? WTI crude oil is up roughly 70% from its year-to-date low, not over 12 months, over a matter of weeks. And this isn't noise. This is a signal. Bank of America just published analysis saying, bluntly, most investors are looking in the wrong direction. And while everyone debates which AI company will win the next infrastructure cycle, the genuinely sophisticated money is rotating into something completely different. Today, we're going to break down exactly what happened, why, where capital is moving, and what it means for how you think about your portfolio. Let's get into it. Welcome back. Today, we're covering a topic that's generating serious discussion inside institutional investment circles right now: sector, rotation, geopolitical risk pricing, and what Bank of America is calling a potential regime change in markets. On the surface, it might look like a simple story. The US and Israel struck Iran. Iran retaliated. Oil spiked. That's the headline version. But markets don't trade headlines. They trade probabilities and the probability distribution. For global energy supply just shifted in a way that is forcing large funds to rethink how they're positioned. What makes this moment interesting isn't just the oil move. It's the underlying data on where institutional money sits right now, what sectors are overweight, what's underweight, and what the gap between current positioning and a more rational allocation looks like. That gap is the story Bank of America has published research that maps this out in detail. And what it shows is that roughly 70% of long-only funds, the pension funds, mutual funds, and insurance companies that move markets, are still underweight energy, despite the rally, despite the geopolitics, despite everything. That's the setup. Let's walk through it step by step. From the geopolitical trigger, to the oil mechanics, to the capital flows, to what it practically means for investors. Let's start with what actually happened, and why it matters more than most geopolitical events. The United States and Israel conducted military strikes against Iran. Iran responded. These aren't just political headlines. They are events that immediately changed the risk calculus for global commodity markets. Because Iran doesn't just produce oil. Iran sits at the intersection of two critical variables for global energy supply. The first is production. Iran is one of the largest oil producers in the world, an OPEC member, and despite years of sanctions, still contribute meaningfully to global supply. Any disruption to Iranian output directly changes the global supply-demand balance. The second, and this is the more powerful factor, is the Strait of Hormuz. This is a narrow waterway, roughly 50 kilometers wide, at its tightest point, running between Iran and Oman. Through it flows approximately 20% of all globally traded oil. That's Saudi crude, UAE crude, Iraqi crude, Kuwaiti crude, all of it passing through a choke point that Iran has repeatedly and explicitly threatened to close. In the event of military escalation, when markets price in geopolitical risk, they're not just reacting to what happened. They're pricing in the probability distribution of what could happen next. A 5% chance that the Strait of Hormuz gets blocked is worth a significant oil premium because the downstream consequences of that scenario would be catastrophic for the global economy. History is instructive here. In 1973, the Arab oil embargo, following the Yom Kippur War, sent oil prices up fourfold within months. Gasoline lines stretched around the block in American cities. The shock triggered a global recession and fundamentally changed how the developed world thought about energy dependency for the next decade. In 1990, Iraq's invasion of Kuwait caused oil to double in price within months. The disruption was significant enough that a US-led coalition launched a war, partly to restore the flow of oil from the Persian Gulf. In 2022, Russia's invasion of Ukraine sent oil above $130 a barrel. Within weeks, Europe found itself scrambling to replace Russian energy supply. Inflation accelerated globally. The war premium remained embedded in energy prices. For over a year, the pattern is consistent. Geopolitical events in oil-producing regions cause rapid, sharp repricing of energy risk. Markets don't wait for physical supply disruptions to occur. They price in the possibility of disruption long before it happens, and sometimes even when it never does. That's not irrationality. That's rational risk management. So when we say oil rallied roughly 70% from its year-to-date low, following the US-Israel-Iran escalation, we're describing a market that is doing exactly what it's supposed to do, repricing the tail risk embedded in a suddenly more dangerous geopolitical environment. Let's talk numbers, because the magnitude here is genuinely striking. West Texas Intermediate, the American benchmark grade that sets the reference price for much of global oil trade, rallied approximately 70% from its year-to-date low. This happened rapidly, not over the course of a year. To calibrate that, the S&P 500 returns roughly 10% per year in a normal environment. A 70% move in a major commodity in a matter of weeks is what traders call a supply shock event. The market isn't repositioning at the margins. It's fundamentally revaluing the probability of real supply disruption. Understanding how oil is priced is important here. Unlike a stock, where price reflects the expected future earnings of a specific company, oil is a global physical commodity. Its price reflects the interaction of several forces simultaneously: OPEC production quotas and compliance, the pace of global economic growth and therefore demand, strategic petroleum reserve levels in major consuming nations, the strength of the US dollar, in which oil is denominated, and, critically, geopolitical risk premiums. That last factor is dominant right now. There's a useful concept from options theory that applies here: the option value of supply disruption. When a geopolitical threat emerges in an oil-producing region, markets aren't just reacting to current physical supply. They're buying insurance against a scenario where supply gets disrupted. The price of that insurance is embedded in the spot price of crude. The higher the perceived probability of disruption, the higher the price, even if the disruption never materializes. This is why oil can surge on the news of military strikes, even before a single barrel of production is actually affected. Now, here's the important market consequence of this move. Funds that were already positioned in energy, whether through direct equity stakes in oil majors or through energy ETFs, saw significant portfolio appreciation. Their energy holdings outperformed the broader market dramatically. The funds that were underweight energy, and Bofe says that's approximately 70% of long-only funds, watched their relative performance suffer. They didn't lose money in absolute terms necessarily, but they underperformed the benchmark. And for professional asset managers, underperforming a benchmark is its own kind of crisis. It triggers client calls, awkward quarterly reviews, and sometimes outflows. This performance pressure is what initiates the next phase: forced buying. Funds that are underweight, a sector that's dramatically outperforming, feel pressure to add exposure. Not because they suddenly love oil, but because their career risk from continued underperformance outweighs the risk of the trade itself. That's the mechanical setup for continued energy demand from institutional allocators. Let's spend some time on the Bank of America analysis specifically, because it's more than just a comment on oil prices. It's a comprehensive snapshot of where institutional money sits right now and where the gaps are. When a major investment bank publishes fund flow and positioning data, it's not offering opinions. It's aggregating actual portfolio data from thousands of funds and mapping it against benchmark weights. It's telling you, empirically, which sectors institutional money is overexposed to and which it's avoiding. That's actionable intelligence. The first key observation from Beauvais: long-only funds started increasing energy sector exposure back in Q4. The rotation into energy began before the Iran strikes. Before the oil spike, the Beauvais strategist flagged this positioning shift before the geopolitical catalyst made it obvious to everyone else. Think about what that implies. Sophisticated institutional managers were already rebalancing toward energy based on valuation gaps. Energy companies were trading at historically cheap multiples. Free cash flow generation: major oil companies were printing enormous cash flows and returning it to shareholders through dividends and buybacks. And macroeconomic positioning: in a higher for longer rate environment with persistent inflation, real assets outperform. The geopolitical trigger accelerated a process that was already underway. It didn't create the rotation, it turbocharged it. The second key observation, and this one has real forward implications: despite the Q4 rotation, approximately 70% of long-only funds are still underweight energy relative to their benchmarks. Let that number land. 7 out of 10 major institutional funds are running less energy exposure than the index they're benchmarked against. In a sector that just moved 70% from its lows, the mechanics of this matter. If an institutional fund is benchmarked against, say, the S&P 500, and energy represents 4% of that index, but the fund only has 2% energy exposure, it's running a 2 percentage point underweight. Every time energy outperforms the rest of the market, that fund underperforms its benchmark by a proportional amount. The implication: if energy continues to perform well, or if geopolitical tension persists, the remaining 70% of underweight funds face mounting pressure to add exposure. That potential buying flow is a structural tailwind for the sector, and it hasn't fully played out yet. This is the analytical lens that Beauvais is highlighting. Not oil went up, but here is the structural setup for continued capital flows into energy, based on what institutional positioning data actually shows. Now let's zoom out to the broader market picture, because what's happening isn't just about energy. It's a systemic shift in how investors are allocating capital across the entire economy. Sector rotation is one of the most fundamental mechanics of investing. Money doesn't leave markets. It moves within them. Different sectors perform better in different phases of the economic and interest rate cycle. Understanding where we are in that cycle and where capital is flowing is one of the most valuable skills an investor can develop. So, where is capital flowing right now? According to Beauvais's data, institutional managers are simultaneously making 2 types of moves. They're adding to energy, the direct play on oil prices and geopolitical risk. Real estate, REITs have historically been effective inflation hedges because the value of physical real estate tends to rise with the general price level. Healthcare, this is classic defensive positioning. Demand for pharmaceuticals and medical services is largely inelastic. It doesn't disappear in a slowdown. And demographic tailwinds, aging populations across the developed world, create a structural growth story independent of the macro cycle. Consumer staples, companies that sell food, household goods, and basic necessities. Their revenues are stable precisely because their products are non-discretionary. You keep buying soap and groceries, even in a recession. They're reducing. Materials, producers of metals, chemicals, and construction materials. This is interesting and somewhat counterintuitive. We'll come back to it. AI-related companies, hyperscalers, the mega-cap cloud and technology platforms, Microsoft, Amazon, Alphabet, Meta, the companies that have been the dominant narrative driving market returns for the past 2 years. That last point deserves emphasis. The companies that powered the bull market, the Magnificent Seven, the AI infrastructure plays, the hyperscale cloud operators, are seeing institutional selling. Not panic selling, not capitulation, but disciplined profit-taking and reallocation. Why now? Several factors converging simultaneously. First, valuations. After 2 years of enormous gains, many AI-adjacent technology companies are trading at multiples that price in a great deal of future success. The margin for disappointment is thin. Second, execution risk. Investors are starting to ask whether the enormous capital expenditures going into AI infrastructure will translate into proportional earnings growth. Third, the macro environment. In a world of persistent inflation and elevated interest rates, long-duration assets, which is what growth stocks are, face a structural headwind. That didn't exist in 2020 or 2021. The combination of these factors is driving capital from high multiple growth narratives into lower multiple real economy businesses. That's sector rotation in its purest form. Let's bring everything together and step back to look at the full picture. We started with geopolitics. Military strikes in the Middle East, specifically the US-Israel action against Iran and the subsequent Iranian response, changed the global energy risk calculus. The Strait of Hormuz, Iranian production, the tail risk of supply disruption. All of it got repriced. WTI crude oil rallied approximately 70% from its year-to-date low. Markets were doing exactly what they're designed to do, pricing probabilities. That oil move triggered a broader rotation. Capital is moving out of AI companies and hyperscalers, the dominant narrative of the past 2 years, and into energy, financials, healthcare, and real estate. From long-duration growth narratives to real asset, real economy businesses. Bank of America's data reveals the structural setup. Approximately 70% of long-only funds are still underweight energy, despite the rally. That gap between current positioning and rational benchmark alignment represents potential future buying pressure. Gold has come off its crowded positioning from last summer. Part of that protective capital has migrated into energy, which has emerged as a more direct geopolitical hedge. At the macro level, Beauvais is pointing to a regime shift, rising dispersion, growing active share, and a factor environment that favors value over growth. So you don't miss the next one. We'll keep following the data. No hype, no clickbait, just the evidence. See you next time.